Morning, everyone. I think Rishi, you are a Rishi, so Rishi तुल्य ज्ञान सबको आप आज दे पाएंगे. Had it not been for the ticket size of 10 lakh rupees, why have AIFs not been able to do what SIFs are willing to do in a long short fund? And why I'm asking this question to you is because you have managed quant strategies in your career earlier, and I think this event for the SIF is probably to raise the awareness of what SIF means actually. So for you, when distributors actually Rishi, hear the term specialized investment funds, it still sounds like complex. So is it that due to quant it will become simple, or because Rishi is managing it will become simple, or how is it if you want to?
No, good morning, everyone. Thanks for that question, Amit. So interesting question and interesting way you put it. So specialized investment funds, I think, to begin with, simplistically, one should think of it as mutual fund plus. It is on a mutual fund platform, and as some of the speakers before me have touched upon, obviously you're getting the regulatory structure of a mutual fund, tightly regulated by SEBI. The transparency is there. So that makes it easy. There is operational simplicity also because of the mutual fund. And then, of course, coming to why it is needed, and then I'll touch upon the AIF aspect also that you mentioned. So obviously, currently in mutual funds, we have equity and we have fixed income, right? And as we all know, there's a lot that can happen in between. But we don't have anything on that at all in India until the SIFs were announced. And there, as we know, equity is very good. It is required in all portfolios, but it only does well when markets go up. And I think at this point in time, especially when the last 18 months has not been great for Indian markets, it's a very interesting time we're talking about it. Because if you had strategies and products which could have done well in this period, right? So that is what SIFs bring in, because you don't need markets only to go up. These kind of strategies can potentially do well when markets are going down or sideways. So there are a lot more scenarios that you can cover. And then on the fixed income side, if you go, then obviously we know there is a taxation angle that comes in, which is not easy. You're making consistent returns, but then tax eats away a lot of it. And again, you can have sort of fixed income plus or arbitrage plus strategies using SIFs, which still get equity-like taxation. So it is sort of solving the need of strategies missing for downward to sideways markets, and it is also solving the tax issue. This combination makes it very powerful. Of course, in the AIFs, you could do such sophisticated strategies and long short and other things, which I'll try to explain in a simple manner also as we go ahead in today's talk. But the issue, a big issue was the taxation, right? Using derivative strategies, you would straight away get taxed at 40%. So however well you do, your return numbers are going to be much lower, which just means that your bar for returns becomes much higher in those strategies. And if you start trying to target very high returns, then obviously risk will increase. And the whole point is that if I can target very attractive risk-adjusted returns with low risk, get absolute returns or arbitrage plus returns, then that is a very sweet spot that the SIFs can target, which has been missing completely in India right now.
Okay, if you really come to think of it as a layman, how I would say that AIF is like your iPhone 17 Pro Max, okay, which can be afforded by select few. And then is SIF the iPhone 17 Lite, where the same strategies at a 1 crore level now are available at 10 lakhs. Is it how we are going to position it, or we are giving hope that your normal long only equity funds might not move to cash, but because of an option here to go short on the market, will probably have a lower standard deviation, yet the result will be positive for the investor? Is it not that we are building a hope for investors by saying that SIF will do better in a flat market or in a volatile situation compared to a long only equity? What ideal time period one should look at when you're putting money here?
Yeah, so I think to answer that question, you'll need to break it down. As we know, there are two types of SIFs that have launched so far. And obviously, SEBI has given many more categories, but a lot of them require either more instruments or more sophistication. So I think those will come down the line. But to begin with, we have all seen equity long short SIFs, and then we've seen hybrid SIFs as well. So on the equity side, I think that is where more confusion lies, because typically when you talk to an HNI client, then immediately when one thinks about equity long short, the question is, oh, will I get equity-like returns or better returns actually with much lower risk? Now that obviously I think is a false expectation. That is not going to happen for sure. Because the simple thought that 25% short that you can go means that you can make money on that 25% short is actually not true, because markets over time tend to go up. So tactically it will help you. But also remember that even if that 25% short makes money, it is taking away from your 100% long, right? So first you are making 75% of the market upside, and then the 25% short needs to make up further, which is virtually impossible to do across all time periods. So for sure, equity long short will be an equity minus product. Yes, it can happen with much lower risk depending on the strategy. So the way I would look at those strategies is the risk reward. If equities is giving you, in the long term, we've seen more like 13%, but it all depends on your expectation and your portfolio construction. If you think the next 10 years can be slightly higher, let's say 15%, which is sort of my expectation, then, you would say, okay, this can deliver 13, 14, 15%, but in equity markets, you would see 20, 30% decline when markets fall. Here, maybe I can control that decline in single digits. If I can do that for those kind of returns, that's still a very great outcome. So I think that is on the equity side. The hybrid category, I think, from an immediate perspective, is what has the much larger opportunity for me, for all of you, because that is where the earlier gap I was talking about, that between equity and fixed income, things are missing. So if you can be more fixed income like, have only 1, 2, 3% max kind of drawdowns downside, 2, 3, 4% kind of annualized volatility, which becomes like fixed income plus or arbitrage plus, and still deliver that arbitrage plus 2, 3% kind of returns, because of the taxation benefit that you get, because it will be equity taxation, I think that becomes an amazing spot and is something that is required, I think, for all portfolios. And therefore, it fits into a portfolio allocation approach, which is what I think we all need to move towards, rather than just having product level conversations, which is what we typically do in India.
Sure. Among the SIF strategies, I think you guys in 9 months of launch of your asset management company decided to come into this category of specialized investments. Was it because of you pushed the envelope because you have managed quant strategies? Was it because you felt that this is one where we can actually use our proprietary software and make good use of that and probably deliver better? Or we probably felt that you need to be on the right side of the distributor now, so you need to be on the SIF side?
Okay. Great question. So obviously, it is a full platform approach that we follow.
Nobody's paying me to ask this, please. So,
so not at all on the third question, but overall, it starts with the objective of the joint venture. So if I take a step back, one of the key objectives of the Jio BlackRock joint venture is to have financial inclusion across the length and breadth of the country, right? And I and Sid both have said this in earlier conversations, earlier events, that we've gone therefore launching products very thoughtfully, right? From liquid fund, money market fund to index fund. So it's almost like a new investor, what journey he should ideally have and how he should build his portfolio. And that sort of relates to what I said just before this, that this was the missing piece, right? Something which can fit in between, still have the tax advantage and deliver those arbitrage plus kind of returns. So when we looked at that, since our initial building blocks have been launched, then this was sort of a natural progression in that, especially for the 10 lakh plus kind of category. And obviously a lot of investors apart from distributors, direct investors as well, have been asking for that. Now, when we looked at that space, then that is where we said, okay, do we have the right platform? Do we have the right people? Do we have the right strategies? Because one thing is that, yes, I need that in my product launch sequence. Second is, do I have the right skill sets and the right tools to be able to manage it? Luckily and interestingly, we did have. Sid mentioned about BlackRock having done these kind of strategies for a very long time, Aladdin being enabled to manage such strategies, manage the risk, etc. So that was the first piece which came in. Second was the team. So yes, there, of course, the fact that I have done long short strategies in the past, not only me, there are some other people in the team also who have done that. That helped. And then to keep the risks low, very importantly, for the hybrid strategy, you need to have multiple strategies. So I think that is another place where all of us, need to fully understand that no single strategy will always do well. And however tightly you manage the risk, no single strategy is going to give you the risk return that we are talking of even in the hybrid space. So there you need multiple strategies. And what that means is that, in sort of the hybrid SIF we are planning, we want to have callers, we want to have merger arbitrage, we want to have REITs and InvITs also.
A special situation, come REITs, InvIT, come.
Yeah. So there, I'm not an expert in REITs and InvITs, for example, right? But there are people in the team who are. So even that helped. So when we looked at that we have a multitude of strategies, and these are actually non-correlated. So therefore, they are each, bringing risk down of the overall portfolio of the overall strategy. Then that is where we started getting excited that, okay, now we have the platform, we have the tools, we have the people, we have the multi-strategy approach, and therefore there is a very high probability. I'm a quant, so I will never say certainty. There's always a chance. There will be a variation. No backtest is perfect. I myself have been saying for a long, long time, any backtest, even if BlackRock is doing it, which is obviously doing it in the most sophisticated manner globally, even then, many of you I've met in the room know that I discount all backtests, all simulations by 10, 15, 20%, depending on the kind of strategy we are forming. So despite doing all that, we saw that, we have a very interesting strategy. And going forward, I think risk management becomes the most key, because when I'm telling you absolute returns, with consistent alpha, then I better stick to absolute returns, meaning that I need to manage the tail risk. So for example, why I called one of the strategies callers and not covered calls, which is what I think all of you are used to hearing, is because we are fully tail risk protected. So, right? So which globally is called callers. Because there I don't want to take the tail risk hedge. What if in the recent war, it had ended up becoming World War III, and suddenly, you heard news of Russia and China, and suddenly you saw 10 or 20% gap down happening. Then even in a covered call strategy without the downside put hedge, you would lose a lot. And I am telling you that I will manage the risk, I will do absolute return, so then, I better be protected for that scenario. So I think all these things will be required. Obviously, that is where the sophistication comes in. And that is where more learning, more awareness, more education needs to come in. And, all of us, all of you obviously need to be more aware, do more due diligence also on all these strategies. Because otherwise, different funds doing headline SIDs for SEBI are going to be the same for everybody, right? So really understanding which fund will focus on what type of strategies and where the risk management comes from is, I think, the most important. And from Geo BlackRock, obviously, we have a clear focus on, investor education, training, having the right content out there. So very happy to help all of you, with doing a deep dive and understanding some of these strategies and the risks that arise in more detail.
Yeah, somebody was mentioning to me that the number of trainers on SIF are more than the actual registered distributors on SIF. So, yeah, so training is important.
The training of the trainers needs to be checked.
Absolutely right. Do you think that the current unhedged position of 25% of AUM which is being allowed, that limit should go up, or will it go up over time, and will that really add to covering the risk or enhancing the return? How should one look at it, and have you guys actually managed such kind of strategies abroad? What has been the experience there?
Yeah, so I think we are all aware that initially when the discussion paper on SIFs had come the first time, SEBI had talked about a 50% short exposure limit in the beginning. Finally, when the final rules came, it was 25%. And I think the indication from SEBI was that because it's very new regulation, very new strategy, even for 10 lakh plus, like, that kind of segment also. So therefore, they would take a measured approach, which I think is very, very fair from a regulatory standpoint, from an investor education standpoint. That is the right approach. Over time, I think if things go well, then the regulator would be open to improving it. From our perspective, we would go through that journey in a measured manner as well, because, like I said, we also need to educate the market and make sure that the initial results are actually coming in line with what we and you are expecting. So for that, I think 25% is good enough for all this combination of strategies that I spoke of. These combined can deliver the arbitrage plus 2-3% returns with that really, really tight risk controls that I was referring to earlier. And therefore, it is good. If we get the 50% or more than 25% kind of short exposure limits in the future, then yes, there are a couple of more strategies or more dynamism that we can bring into the portfolio. So from a long-term perspective, I would be very open to it. But it is not as if it would change the overall dynamics too much. It is just that maybe I can add a few more strategies, be a bit more diversified.
Will it change the output though in terms of returns?
Again, so equity long short side, it may help a little bit. I think hybrid side, the current thing is good enough.
I mean, as MFDs, there are a lot of do's and don'ts which Amphi keeps on sending us. On SIF, what are the do's and don'ts you think that a MFD should actually look at? Because lost in translation, what the fund manager says through Chinese whispers up to the client, many of us probably will not carry the same message what you want to actually convey. So any quick don'ts for the MFDs when they are looking at SIS for their customers?
So don'ts clearly, I mean, when clients think these can give you equity plus returns, then clearly please explain to them that it is not possible, as I said earlier. And even from your perspective, even if it's equity long short, I don't think it will fit into the equity kind of bucket. So definitely don't make that mistake. Secondly, the risk management part of it, as I sort of alluded to earlier, I think do a deep dive, do a full due diligence of, every manager, the kind of different strategies they're talking of, how is the risk controlled, how is the risk managed. If it is protected strategies, then it better be, largely fully protected. If it is equity long short where different stocks, one is going long and short, then what is that, the risk that both sides can go wrong? I think we are all scared about that.
Yeah.
If it is same sector, there's less chances of that happening. There are factor neutral strategies. If one gets more sophisticated, there's less chances of that happening. But there the approach matters. So really doing a deep dive there, I think will matter a lot. So obviously don't take things at face value. I think doing a deeper dive means a lot more work. But I think, as some of the earlier speakers said, it's potentially a very large category and we are in early days. So I think all that hard work will definitely pay off in the long run.
Yeah. And as a distributor, should I be really be aware of how to trade in future and options to understand SIFs?
No, obviously this is not trading. But broadly what the payoffs can be, and we are very happy to explain it in a very, very simple manner as well. Because when people say covered calls, and I mentioned callers because I'm fully hedged with buying downside put protection.
I think on behalf of MFDs, a training on what covered calls are or what are the strategies, I think we all can really get help from you guys in understanding.
We are more than happy to.
Many of us might not be stockbrokers, so we might not know what an F&O is. So this might really help.
Yeah. So yeah, offline post this session, very happy to explain that to whoever wants to do it and even have a deeper dive session into it for all of you.
Yeah. I think thank you very much for giving this out, and people will definitely look at it from a different lens. Now what you have said, the key message for me is clearly this is not a replacement to long only equities. It is a lower standard deviation arbitrage plus kind of return, and you should probably look at it, deep dive, take it not at face value, but look at the manager, look at its credentials, understand the product, and then probably suggest it.
And I think last message was, move ahead from product conversations and think of it as a portfolio allocation tool. A lot of research out there globally, and again, very happy to dumb it down and explain in a simple manner offline as to how 5, 10, 20% addition of this can make you much more efficient on the efficient frontier and therefore lead to much more robust portfolios.
Yeah, I would sum it up saying that when you enter into a car, don't just look at the accelerator, which most of the MFDs do by allocating 100% to equity. There is also a brake, which probably might be SIF, which can control the volatility in your portfolio. Thank you very much, Rishi, and thank
Thanks.
you all for this.